What exactly is the Bitcoin halving? Because I'm still confused. And how is it going to affect the Bitcoin miners?
Bitcoin halving. The technical event sounds simple. Bitcoin miners get paid in Bitcoin to validate transactions, and every 4 years, that reward is halved. But the event is a big deal. Historically, the halving's cut to supply has led to huge rallies for Bitcoin. Just look at this price chart of Bitcoin from its first transaction in 2009. Each halving event has set the stage for a brand new bull run, new all-time highs, and new Bitcoin investors entering the market.
So what exactly is the Bitcoin halving? Miners on the network get paid in Bitcoin for verifying transactions, and every 4 years, the supply of new Bitcoin created to reward miners gets cut in half. This process is hard-coded into the Bitcoin protocol itself, meaning no one can change it. This process takes place every 210,000 blocks. A block is a collection of verified transactions grouped together. With blocks being validated roughly every 10 minutes, that works out to about every 4 years. Now, the halving affects the rate at which new Bitcoins are brought into circulation. The supply of Bitcoin is finite. Only 21 million will ever exist. Cutting mining rewards means fewer Bitcoin will enter the market every day. That makes Bitcoin more scarce after each halving. Bitcoin prices have historically risen after past halving events. So for investors, it could mean big returns. For miners, it could mean big losses. If they don't find ways to become more efficient, some miners could even go out of business.
So why is this Bitcoin halving in 2024? Why is that any different than the prior ones?
Investors are excited because the halving has historically set the stage for Bitcoin's next bull cycle. The event cuts the number of new Bitcoin entering the network each day, and that means tighter supply.
Bitcoin now has a clear demand on a very scarce asset, and that asset is about to get even more scarce with Bitcoin halving.
But this time, things look a lot different for the world's largest cryptocurrency. Crypto World's Tanea McKeel explains why.
2024's Bitcoin halving is getting a lot of attention. The technical event that cuts the reward paid out to miners happens roughly every 4 years. In the past, it was only celebrated by a few of the cryptocurrency's biggest cheerleaders. This year, though,
Sometime in the next 12, 18 months, Bitcoin can be over 150,000.
Around the halving, where the amount of Bitcoin coming to market is cut in half. After that time period, you see another year of a bull market.
and the reason for all the attention, there are way more people who care about and invest in Bitcoin than there were in 2020 during the last halving. That's thanks to a wave of adoption during the last cycle and new investment options for crypto-curious investors like spot ETFs.
So if the Bitcoin ETF created a demand, why is this different from any other ETF? Because you can buy an ETF for anything on Wall Street.
This was the defining moment, I think, of Bitcoin, at least, right? In this era of its history. Like, this was its kind of IPO-like moment. Pandora's box is now open for institutional adoption of the asset class.
Investors are excited because the halving has historically set the stage for Bitcoin's next bull cycle. The event cuts the number of new Bitcoin entering the network each day, and that means tighter supply.
Bitcoin now has a clear demand on a very scarce asset, and that asset is about to get even more scarce with Bitcoin halving.
So we have two catalysts for this next Bitcoin bull run. The first catalyst was the ETF. The second catalyst is the halving.
Of course, past performance isn't indicative of future results, and the market is very different this time around.
Huge maturation of the asset class, infrastructure development, more people than ever being interested in it.
Investors are hoping that this halving event will also lead to big gains, but others think that those golden days of the halving supercharging the market might be behind us. Julio Moreno of CryptoQuant called the halving a once significant event.
So what should I expect to happen to my money in Bitcoin now that this halving has happened and this ETF has happened? How will I make money with this halving, and how long will it take?
With all the hype and debate, what should you expect for Bitcoin's price in the near term?
So immediately after, if we're going to define that as like 24 hours, 48 hours, a week, like really short term, I don't expect you're going to see much at all. It's not a short-term phenomenon. This is a $30 million a day reduction in sell pressure. That effect builds over time. So while that will have an effect on the market, 1 day, 2 days, 3 days, 4 days after, I don't think you're going to see a whole lot.
That added scarcity often kickstarts Bitcoin's rally to new all-time highs. Looking back at the 2012, 2016, and 2020 halvings, Bitcoin's price ran up about 93 times, 30 times, and 8 times, respectively, from its halving day price to its cycle top. And in the long term, well, if you noticed earlier, each halving event has provided diminishing returns. 2012 saw a bigger rally than 2016, and so on.
So if each halving causes diminishing returns, how am I going to make money? I guess instead of that 8x in 2020, I'm only going to make 2 or 3x.
I'll come out and say I am a skeptic on the fact that the diminishing returns will happen this year. I think this year we see a greater return than last cycle.
So this guy thinks that the demand is going to come from people hitting the buy button on their brokerage accounts because now Bitcoin is offered on many different platforms and through many different brokerages. The ETF caused this.
You know, ultimately what drives an asset price up, any asset price, is not financial models, it's not cash flows, it's people hitting the buy button in their brokerage account.
So he thinks that half the supply out there has nothing to do with the demand. And now this other guy thinks that this is just a mirage. This is just a headline. And because it's a headline, the halving, people will have a demand for it when they see the halving headline.
I think it's a little bit of a self-fulfilling prophecy where certainly, a reduction in issuance of Bitcoin does help the price by making it more scarce. But a large part of it is also just bringing it back into headlines, having it be top of mind. In practice, the ETF flows are substantially larger than any sort of increased issuance in Bitcoin from Bitcoin miners. So I think it's not more of a material change and more of just a change in perception of the asset.
So what does the Bitcoin ETF and the halving have to do with the miners?
Now, while this event may have a big effect on price, the most direct impact is on the Bitcoin miners. There are more than a dozen publicly traded miners on the network and thousands of smaller private ones around the globe constantly racing to process transactions and get paid in new Bitcoin. Because the event leads to a cut to rewards paid to miners directly, they'll be the first ones to feel the impact of the halving. Crypto World's Talia Kaplan explains how some of the largest publicly traded miners have expanded their businesses to prepare for this cut to their revenue.
So if the miners are making more money per coin, shouldn't that be good for them? Then the smaller miners that don't have the machines and the infrastructure to mine Bitcoin, they will go out of business because they don't have the capital to build more infrastructure.
Bitcoin miners are preparing for the network's biggest event in 4 years.
We have a halving coming up here, and Riot has a number of ambitious growth plans that we're scaling up our business with. So as the price of Bitcoin appreciates, we should appreciate from that in an outsized way.
The rally in Bitcoin really is what's keeping miners in business today when you think about post-halving. The average cost to mine a Bitcoin is somewhere around between $20,000 to $25,000 a Bitcoin currently. Post the halving, that'll go to somewhere between $37,000 to $45,000 a Bitcoin, maybe $50,000 a Bitcoin in some cases for some miners. And with the Bitcoin price being at 67, 68, 70,000, it means that miners are still mining profitably. Though, what it really means is the miners with large scale will be able to mine profitably. The smaller miners will be put under more pressure. I think if you look globally, potentially about 15% of the capacity may come under pressure. And by that, I mean that those operations may be unprofitable. And so those miners that have machines that are above the global average in energy consumption will likely come under pressure. So we'll have to see, but I think most of the publicly traded miners are fairly well positioned at this point.
Essentially, Bitcoin miners will be in business until 2140. It will only be the best of breed that survive.
The first halving event took place in 2012, 4 years after the first block was mined on the network. Jump to the most recent halving, 12.5 new Bitcoins were added to the network at the beginning of 2020. In May, that number was cut in half to 6.25. This latest halving will drop rewards to around 3.125, and that process will continue until all 21 million coins have been mined. The expectation is that should happen in about 116 years from now.
Riot is positioned to exit 2024 mining more Bitcoin per day than it is right now despite the halving occurring. We are scaling up our operations by almost a factor of 3, and we are implementing an ongoing power strategy that helps decrease our energy costs and gives us an industry-leading cost of production. Our direct cost per Bitcoin in 2023 was just about $7,500 a coin. Now that increases with the halving, but with the price appreciating at a faster rate, we think we are in a very good spot alongside everything we're executing on this year.
So essentially, this halving is flushing out all of the lower tier Bitcoin miners, and only the best of breed will survive, just like every other company in the world.
I think that we will see failures in the space. We already saw in the last market, there were a couple bankruptcies, both in the public and the private space. I think we're going to see that again. So I think that there's going to be great opportunity on an M&A basis. If you think about the Bitcoin rewards as, the pie got smaller, and all the miners that exist, it's about the size of that pie. We think that there will be miners that are less efficient and can't handle that revenue shock. So we think as many as 30% or 15 to 30% of miners will actually have to turn off, shut down.
So in order for Bitcoin miners to survive, they need to ramp up production. They need to buy more data centers, more machines, more infrastructure, or else they won't survive.
Miners are expanding their footprint to boost their capacity in an effort to limit their losses post-halving. Riot acquired more than 31,000 mining machines in February. That same month, CleanSpark announced it completed the acquisition of 3 Bitcoin mining data centers in Mississippi, which boosted the company's operating hash rate. Earlier this month, Marathon Digital closed a previously announced acquisition of a 200 megawatt Bitcoin mining data center in Texas.
The benefit of owning and operating these sites is that it essentially lowers our cost to operate. It lowers our cost to mine Bitcoin because we're now taking out the middleman, if you would. The other thing that's been a very positive impact of this is we've been able to acquire these sites at lower than replacement cost, meaning a cost below what it would have cost us to build them in the first place. So this is a great way of kind of being able to expand quickly, leverage other people's capital. They build the sites, and then we come in when the market gets a little weaker for sites and acquire the sites. And it's been a very good strategy for us so far, but we'll continue to acquire sites, and our objective is to be predominantly owned and operated going forward.
So then the best of breed Bitcoin miners will survive because they have already built infrastructure, they already have the network in place, and they're spending CapEx on building more infrastructure.
We need to be efficient in order to survive, and Bitcoin and Bitcoin mining is no different to any other industry.
Phil Harvey is the founder and CEO of Saber56, a hosting provider and crypto mining consultant. He expects to see consolidation among miners following the upcoming halving.
Now we're seeing in the space a lot of mergers and acquisitions taking place because the power just isn't there for people to grow into. So those underlying assets, the power purchase agreements, PPAs, are becoming extremely lucrative. So yes, there will be miners that don't have the capital in order to reinvest, and therefore, provided they have lucrative underlying power asset, will become an M&A target.